Hi, everyone. This is Tim Melvin of the Deep Value Newsletter and the Banking on Profits report, coming to you from down here in Central Florida, where the morning rain has finally faded away and we're back to a very nice sunny day out there, about 85 degrees. Really love this time of year. Be sending the weather forecast to all my friends up in Maryland, and of course my daughter in Chicago will be getting it on a daily basis, especially once it starts snowing up there. I'm just going to have so much fun with that. I realize that probably makes me a bad person, but I'm actually okay with it. Fed Day has finally, at long last, come and gone, and the TV and the airways and the prognosticators have all been full of not so much what was the Fed going to do. Nobody expected an interest rate hike at this meeting, but what the language in the report might say to give them hope for an interest rate increase at the December meeting. And guess what? They got it. The Fed said that they will monitor the situation to see if it merits a hike at their next meeting, which of course is December. And everybody's very excited about this. Bonds immediately sold off, stocks trimmed, dollar went a little bit higher. It's a special form of insanity. And again, the consensus is that we were probably looking out towards March. There was only a 30% chance of a rate hike in December. So anybody that bet that way got pretty much slaughtered today. Now all the bets are going to get in that we have this big hike, or big hike, 25 basis points in December, and there's just as much chance of being wrong. Fed language aside, if you remember, as we got into the September meeting, it was considered to be almost a lock that they were going to raise interest rates. The data had been coming in pretty good. The economy looked better, and then we got just disastrous international news, and the markets started to tank a little bit, and the Fed said, whoa, we better not raise here. And as the economic news and international economic news continued to come in, continued to be pretty bleak, and everybody decided it would now be March. Now everybody thinks it's December. I don't really care. Okay? With where the market is today, the Fed's going to have to raise interest rates several times in a row before it creates a whole bunch of opportunities for us as deep value investors. I don't think that a 25 basis point hike is going to create a whole lot of inventory of safe and cheap stocks. Remember, this market is still quite expensive. It's at 21 times trailing earnings, which it's not 1999 levels, but it's 2007 levels to be sure. And the total market cap right now is 120% of GDP, which is just a little rich. So we're not going to see an extreme buying opportunity just because of one or two moves from the Fed. It's going to take something more than that. I suspect it'll be a geopolitical event that gets the markets tumbling down into the range where I can once again get real excited about stocks. Until then, and I wrote on Real Money today, quoting that great investment analyst and philosopher Winnie the Pooh, never underestimate the importance of doing nothing. There's not a lot to buy. We're already positioned. We got all our community banks. The community bank portion of our portfolio is just stuffed full of safe and cheap community banks, and good things are happening. We had 3 mergers just in the last month, and there's been a whole bunch of mergers taking place in the space where we didn't already own the stock. There's still a few, about 30 banks around to buy that are safe, they're cheap, they have activist involvement, and they belong in your portfolio. If they're not there, you're making a huge mistake. But we've got some REITs that are trading at a discount. 1 or 2 others that we'd like to add. They just need to pull back a little bit. We've got some closed-end funds trading at a pretty steep discount that we're very comfortable owning as long-term investors. They're paying very generous cash distributions. We've got some stocks that we think are safe and cheap, and we've got just a ton of cash. And we're quite content to sit here for now and do nothing. We have if we can find it, we will buy it mentality. We can't find it, we're not going to force it. So we'll join our stuffed bear little friend, and we're going to keep eating honey, but we're going to sit on the sidelines drinking coffee out of our grumpy coffee cup and do nothing for now, because there's simply nothing to do in the current market. Now, I don't know that the Fed's going to rush to raise rates at the December meeting. Just looking at the headlines today, okay, global steel demand, particularly out of China, collapsing and getting worse, should continue to decrease not only this year, but next year, according to the analysts cited in this one article. Osprey Capital came out and they said they have a negative outlook for all industrial metals. They called the aluminum market miserable. Let's see, electricity demand declining in the United States. These are just today's headlines that I pulled out on the U.S. and the global economy. So this is not a real robust economy. Fed has to move carefully here. I do agree with the bankers at the FIG conference earlier this month that I spoke to. I think the Fed is in a box. They need to get a couple rate hikes in, because if anything goes wrong geopolitically or domestically in the economy, the only weapon they have left would be QE4, and the market's not going to take to that very kindly, because that will be an indication that things are indeed far worse than many had anticipated. So we're going to see how all this plays out. In the meantime, I thought, I don't usually do this on the video, I'm going to throw a couple stock ideas out there. These are stocks we've had in the portfolio for a bit. They're still very cheap. They're a little larger cap than a lot of the portfolios, and no, you're not getting a free $20 million community bank idea today. But these stocks, both I think could double or triple. So here we go. And I'm going to put links in the comment section to articles that I wrote about those stocks. First one's a long-term favorite. We had a gain in it. It's ridden back down. But Volt Information is a staffing company on the West Coast. They do a ton of business with the big tech companies. They have for years. It was a family-run company for many, many years, and that was sort of the problem. Very entrenched board. They diversified into businesses they didn't belong into. We got some activists involved in the stock, along with some other institutional investors. The CEO has been replaced with a much more experienced CEO, who we think can get this company turned around and headed in the right direction. The board has been replaced. There are now activist investors on the board. Some of the analysis that I've seen, they seem to think that the company has about $1.50 in earnings power a couple years out. I think they're low. I think it's actually a lot higher than that. They're operating on very low margins of 2%, when the rest of the staffing industry is closer to 4 and 5%. Just a little bit of margin improvement here. I think earnings can be much higher than $1.50, but we'll stay with the $1.50 base case. The stock's around $8 a share. If we put a 10 multiple, say 3 years out, on $1.50 in earnings, we come up with $15 or a near double. Again, if we put something close to the staffing industry norm of, say, 17 to 20, we have a stock price in the high 20s, low 30s. The potential to be a home run. I don't think there's a lot of downside risk in this stock from this price level. The price to book value, stated book value, is a lot lower, but there are some tax assets here that bring the actual asset value of the company up to between 10 and $12 a share. So I think you have plenty of downside protection. I don't think that a lot has to go right. I think things just have to stop going wrong for this company, and you've got a stock that over the next 2 to 3 years can make you quite a bit of money. The other stock that I'll pick is, I've got a lot of laughter on this one, but I think Unisys Corporation is getting ready to turn around in a very big way. The new CEO just came in. He's very experienced at turnarounds. He turned around both Perot Systems and Microsystems and promptly sold them for very large gains for patient shareholders. Hopeful that can happen here again. Now, their cost savings initiatives are $200 million. They're supposed to be at the full run rate per year by the end of 2016. Now, if that happens, folks, that's without business getting any better. It's $4 a share. It drops right to the bottom line. But now, so they're changing the way they sell products. They're going to a more vertical model, selling more services to each company. And the big opportunity here is their Stealth product. It's a cybersecurity system, and they're aiming it primarily at the financial institutions and banks. If they achieve some decent market penetration there, this thing's really going to add to both the top and bottom line for Unisys. In short, 2 to 3 years out, I think you could have a triple in this stock. So, and we just wanted to throw a couple ideas out there, living these little weekly videos up, make up for missing the video last week, because I was in Chicago drinking Old Style in Wrigley Stadium with my son-in-law and watching the Cubs, unfortunately, lose Game 4. Now, the next night, because we no longer had a Game 5 to go to, we went to a great restaurant in Chicago called Prime and Provisions. And if you get a chance, it's not cheap, but wow, was the food spectacular. It's right down there on the South Street across from the river. So if you get a chance, check that place out there. I think it's 221 LaSalle. Fantastic dining experience. The staff was wonderful. The food was out of this world. And they make a pretty mean Manhattan with Templeton rye. Enjoyed a couple of those over dinner. So anyway, tonight we're getting ready. we've been working the finger out all day, getting ready for tonight, because we're going to be switching back and forth between the World Series and the Hell in a Cell cage match known as the GOP debate over on CNBC. So it should be a pretty fun evening. Kind of rooting for the Mets in this one. There's just something about the Kansas City Royals that has irritated me the entire time that they've been in the league, and they've always been a thorn in the Orioles' side, no matter what kind of year they were having. So I'm going to have to overlook 1969 and go along with my good friends Ahmed and Kevin and a few others up there in New York and root for the New York Mets to come back from that devastating 14-inning loss last night. And guys, please, got to get your business done in 9 innings. I'm way too old to be staying up until almost 1:30 in the morning watching baseball. So let's get it done early tonight and get things wrapped up by about 11:30 so this old guy can get his sleep. Anyway, that's all I've got for you this week. We'll be back next week seeing what's happened. I'm looking forward to some more activity in the small bank space. The earnings have been coming in marvelous. We're seeing the dividend increases and buybacks that we've anticipated. And so we expect it to be another great week for both the deep value and the banking all profit service. So anyway, we will talk to you next week. Have a fantastic week, and let's go Mets.